right, hello and welcome back to Understanding Your Economic Engine. This is vlog number 3, Scheduling Your Profit. If you have not watched 1 and 2, I highly recommend you do that first because this builds on those 2 presentations. All right, my name is Rick Phelps. I am a business coach with ActionCOACH Business Coaching. And this series on Understanding Your Economic Engine is about money mastery. It's about understanding how you make profits in your business. It's particularly focused on fabricating and manufacturing companies, but it is applicable across the business spectrum. And so in the first session, we talked about the problems of cost accounting and using that data in your analysis of your business and how you make money. And the second one, we looked at how to focus your improvement efforts so that it actually hits the bottom line, so you don't go doing general improvements using Lean and Six Sigma to spend lots of resources and see no bottom line results. Now we're going to move on to an interesting topic that's called scheduling your profit. That's right. I'm going to show you in this really short vlog how to schedule profits so that you're always making money in your business. Wouldn't that be cool? All right, so here we go. First thing, again, a quick reminder about your reticular activating system. It's a part of your brain that filters out what you see. This can be good and this can be bad. All right, the RAS is a filter that is set based on your thinking. Our cost accounting world has set a set of blinders on us that keeps so many businesses from making the improvements that they need. In the first video, we talked about the view of the coal mine, not realizing that it was trains loaded, not dollars per profit per train that happened. And so their whole mindset shifted and they had ability to 10x or 20x their profitability as a result of a change of simple mindset of taking off some blinders. In the second one, we looked at a Rogers fabricating shop and how just adding a $10 or $12 an hour helper was able to release thousands of dollars in throughput dollars and profits into the business. All right, so now we're going to look at how to schedule profits. All right, and so again, a quick review. We have the normal cost accounting where sales dollars come in, the revenue gets split into gross profit and cost of goods sold. In the cost accounting system, we have materials costs and labor costs and COGS, and then the allocation of costs into variable cost, fixed costs. And each and every product you make gets profit. As we know, since we sometimes have months where we make no money, something ain't right with that picture, right? And so really all the variance analysis, if you're a large company and you do variance analysis, that's a bunch of BS. It's needless complexity. There is a much more powerful, simpler way to look at your world, and it's called throughput counting. Because cost accounting, again, tunes your RAS and puts on a set of blinders that keeps you from making money. All right, and we're in the business to make money. So we simplify, we set up a throughput accounting perspective where cost of goods sold is only the costs that exit the system, and gross profit becomes a specialized number, which is throughput dollars, which is the dollars earned through sales of product. All right, and that mindset takes away the blinders, simplifies your world. You have operating expense bucket instead of multiple buckets. And there is one point in your process that limits the flow of throughput dollars. And we've said over and over, the essence of profound insight is simplicity. So understanding that there's one and only one place, most likely in your business, that really makes an impact on your profitability. That's pretty amazing. That allows you to focus your improvement efforts. All right. We're going to look at how to schedule now so that you always are profitable. And every day of the week, every day of the month, you know exactly what your profit and loss statement is going to tell you at the end of the month. And all it will be when it comes out 3 or 4 or 5 days after the end of the month is, yep, that's what we expected. It's going to be that simple and that powerful. And so what we want to do is we've been looking at this from a month perspective. We're going to keep on that. And so our operating expenses represented by that bucket That's going to be a month's worth of expenses. So it's rent for a month, it's payroll for a month, it's your energy bills for a month. Things come in nice monthly bills. So we're going to keep it in that context. Now, again, all of the pass-through dollars, they've left that system. That's the cost of the inventory, the materials, the subcontracted out labor, and that all that's just pass-through dollars. We're not talking about those monies. We're talking about the operating expenses inside the business that are not directly linked to the production of a specific product. All right, so for 1 month, we have 1 month worth of expenses. We can divide that into 4 weeks. Notice that we are expanding above the tank, right? So we want to schedule, we want to plan on a level of profitability. And so we have above our break-even line, our profit level. And so our profits are factored into what we're trying to do here. And what we want to do is set ourselves up so that at the end of week 1, we have filled our tank to this first line here, that first level of week 1. And week 2, we want to be sure we have filled the tank to the line at week 2. And week 3, similarly, we're approaching break even. And during week 4, we pass through break even and make profit. That's what we want. All right, so back to Roger's shop. Roger had a CNC machine that was his bottleneck. For those of you who are fans of the book The Goal and read it as a result of highlighting it last week, the CNC machine was Herbie. All right, so Herbie limits the throughput, and we want to make sure that we are getting enough materials through that, enough product through the bottleneck or the constraint so that we make money. Now, in this particular fabricating shop, the whole scheduling system was driven not by the production center, but by installs. So there again, we're making Corian countertops, and the scheduling process worked where the person who scheduled installs, so the finished product installation, those installs got set, and then the system, the scheduling system, worked backwards to schedule back through the CNC machine and finishing and procurement and so on and so forth, design and whatnot. And so it was a backwards looking system. And so what we wanted to do is every week make sure that we installed enough countertops to make our target goal. So every week we had a bogey of throughput dollars. Now in this particular business, it was fairly easy to calculate sale price minus cost of goods sold, where cost of goods sold doesn't include the labor, right? And so just material costs, revenue minus material costs gives you throughput dollars. And so we gave the guy who scheduled installs that number and a simple little spreadsheet to tally them up. And we said, every week you need to schedule enough installs to make this many dollars, throughput dollars. And once you made that bogey, you can start filling the next week. But if there's space, keep filling the week. All right. Now, this had an interesting effect. First of all, the fabricating shop initially threw a fit, right? Why are you doing scheduling all this work on it? But that's the level of work they needed to produce. And nothing like creating a crisis to get a solution, right? They very quickly were able to figure out how to shift manpower, how to do things they needed to do, like put the helper on the machine to make sure that product kept flowing. So we forced their hand. And by the way, it was about 3 weeks between the CNC and install. And within 3 weeks, Roger's plant went profitable after not having made money for years, or barely being profitable for years. All of a sudden, it was as easily as scheduling installs at the right level to drive his entire business, to make the decisions that needed to be made, to do what needed to be done to make profits. And so by giving the install scheduler the throughput dollars per job and giving him a bogey of how many throughput dollars to schedule each week, all of a sudden, it wasn't in schedule 5 installs, it was in scheduled $5,000 or whatever the number was of throughput dollars. And voila, they scheduled profit. And by the way, starting on the first of every month, every day they knew exactly or could project exactly how much profit they were anticipating on making each month. And so the big question when the financial statements came out, into the next month, did we make any money? It was a non-event. Of course we made money. We know exactly how much money we made because we knew how many throughput dollars we had produced. All right, so that's scheduling profit. So every week, that many dollars have to come through. And if at the end of the first week, you haven't made it, you got to make it up the next week. All right. Again, there's one and only one constraint in every business. And that's the way you look at it and the way you think about it. What kinds of mindset errors, what kind of blinders do you have on, in addition to the cost accounting blinders, that are keeping your business from making money? Because as Mark Twain loved to say, it ain't what you don't know that gets you into trouble. It's what you know for sure that ain't so. Thank you, Mark, and thank you for watching this, our third blog. Our next blog coming up will be about how these concepts will help you with the quoting process and make a much simpler quoting process that's much more accurate. So join us for the next blog. And if you have any questions, I can be reached at rickphelps@actioncoach.com, or my cell phone rings directly, 216-533-1387. I would love to talk with you about how these concepts can make a profound difference in your business. In the meantime, have a safe and profitable week, and we'll talk to you soon, I hope.